Well, it's 11 a.m. and thought we'd get started here, and thank you everyone for attending today, the BetaShares Franklin Templeton BNDS Why Fixed Income Now. And again, a special thanks to all those who are attending in those rain and flood affected areas. So thank you for making the time today. Just going to the screen here. So as always, we will be recording this webinar today. So if you do miss anything as we go through, it will be sent out shortly after we finish. And if you have any colleagues that couldn't attend today, that'll be going out to them if they're registered. We will have plenty of time at the end for questions. So please do use that little widget box down on the side there to write any questions as we go through the presentation and webinar today. And I'll endeavour to answer as many of those at the end with our speakers. The all-important disclaimer slide, as always. I'll give you a moment to have a quick read over that. A couple of key ones there is this is a financial advisor webinar and not made for retail clients. And of course, past performance is not indicative of future performance when we're referencing to those performance figures in the webinar. So we should all have read that. So just before I introduce the speakers today, and myself, Chris Yates, I'm a director here at BetaShares in the advisor service and part of the business for New South Wales and ACT. I will just get a wee poll up. So hopefully everyone can see that. And that's, do you think the RBA will meet inflation targets over the next 10 years? So if you could all pop your answers in on what your view of that is, and we'll probably cover that one off as we go through the webinar or through the Q&A at the end. Just wait for a few more to come through. Okay, looks like we're leaning towards a yes so far. And there we go, I'll just finish that up now. Well, it started off strong with yes, but finished even stronger with no. So we have 51% say no, we won't meet that in the next 10 years, and 49. So, you know, pretty even there. So I guess we can talk about that a little bit later. So introducing our speakers for today, we're very lucky to have two specialists within the fixed income market, which is Chamath Silva, who's a portfolio manager here at BetaShares, and we actually have a bit of a late change. We have Anthony Kirkham, who is going to be covering John Beard's spot today, just because of an illness there. So on to the agenda. So the welcomes are done. I'm going to be doing an update on BetaShares and our partnership with Franklin Templeton and Western Asset. Chum will be covering a macro outlook, and then we'll have Anthony covering BNDS, which is our Australian bond fund, how that strategy and fund is managed, and of course the role of fixed income as well. And we will again have time for some questions and answers at the end. So an update on BetaShares and Franklin Templeton. So BetaShares, we are a leading ETF fund manager here in Australia. We manage over $16 billion of funds under management, and that is varying across a number of strategies, from low-cost ASX 200 exposure at 7 basis points to ethical, thematic, sector or factor-based ETFs, all the way through actively managed strategies. And that's where our partnership with Franklin Templeton really comes into, is to give access to these high conviction strategies via the ASX to retail, advised and institutional clients. So the funds that we have with partnership with Franklin Templeton and Legg is the BetaShares Legg Australian Bond Fund, which goes under that ticker code of BNDS. But also the Martin Curry team have 3 other strategies, which is the Equity Income Fund, which is under the ticker code of EINC, and also the Real Income Fund, which is under RINC, and an Emerging Market Fund under EMMG. And again, these strategies is a way of giving access to those high conviction strategies and specialist investment managers through Western Asset and Legg, Mason, Martin Currie. Now, Franklin Templeton acquired Legg Mason halfway through last year in July, which that made Franklin Templeton the 6th largest asset manager globally. So they manage over $1.9 trillion, 70 plus years of asset management experience, and really that global reach with offices in over 34 countries around the world. So I will leave it at that in terms of the update and pass it over to Chum now to give a macro outlook. Chum, over to you, mate.
Okay, thanks, Chris. So I might just start with how we see the role of fixed income more broadly, and particularly in the role of, or in the context of multi-asset portfolios, and move on to why we think high-grade bonds still have a role in strategic asset allocation. Okay. So we think fixed income in balanced portfolios should focus on liquidity, equity diversification, and the potential to profit from adverse portfolio and not what they're just currently yielding. High-grade fixed-rate bonds provide superior excess returns to cash, can mitigate equity risk in portfolios, and can benefit from a deterioration in either domestic or global economic conditions. Now on the next slide, so if we just have a look at how, say, high-grade bonds have performed over cash over the long run, just using an example of US investment grade versus US Treasury bills. And we see a period covering 50 years and multiple inflation cycles and interest rate regimes. You know, we do see that fixed income and duration in particular has generally rewarded investors, delivering excess returns over cash over the long run. And we expect that to continue going forward for reasons I'll go through in a moment. And this table is basically the same for Australian investment grade bonds. So right now, so cash rates might be around zero, but government bond yields are not. Right now, the longer end of the Australian yield curve is, yielding levels that, we last saw a couple of years ago. So even in a low interest rate environment, steep yield curves can provide excess returns over cash due to a combination of carry and roll down. But high grade bonds can also still provide plenty of equity diversification and as well as providing liquidity to take advantage of corrections and dislocations in risk assets. And just to show just that the Australian yield curve is very steep. So, and the thing to remember is, when a yield curve is steep, it does provide a fair amount of cushion against the potential for policy rates to increase going forward. And if you don't expect policy rates to increase, then there is a lot of risk premium that you can harvest from a steep yield curve. And this chart basically shows 5-year rolling excess returns on 5 to 10-year Commonwealth government bonds against cash, against say the starting or the average spread between the yield on 10-year government bonds and cash. And the key point is that a steep curve and a wide yield differential versus cash does drive excess returns going forward. And right now, we have 10-year bonds yielding, over 150 basis points around over cash. So there is a decent expectation that bonds will continue to outperform cash going forward. And something to keep in mind, about how much buffer the current yield provides and the current steepness of the curve is that right now, given where longer-term Australian bonds are yielding, it would require a very aggressive RBA rate hiking cycle for bonds to underperform cash over the next 10 years. And just as an example, we've provided a bit of a scenario, assuming the RBA begins a hiking cycle in 3 years' time. And based on the current 10-year yield, the RBA will need to hike around 11 times, ending at a terminal rate of around 2.75% sometime in 2026. So, for the RBA to undertake such an aggressive rate hike cycle, you need to, obviously it's important to assess whether our economy can handle such a rise in debt servicing costs over such a short period. And I might just touch on also, we believe that duration does provide equity diversification benefits, and historically equity portfolios or portfolios, where equity risk has been the main driver of overall portfolio risk, has benefited from, more interest rate duration as opposed to credit risk. So the top panel shows the returns on a pure duration exposure, comparing very long-term US Treasuries against intermediate US Treasuries, and the orange line shows the return on spread duration. So that's the excess return on credit from investment grade corporate bonds. And what you do see is that credit returns tend to be fairly highly correlated with equity returns if you compare it to the bottom panel, showing both the S&P 500 and the VIX. And that correlation tends to increase during periods of market stress. And I'll just add that, especially because of there is that asymmetric, downside risk with a lot of credit exposures. So that's something to keep in mind if you are using fixed income primarily to fortify your portfolios and to provide a ballast against weakness in equity markets. And finally, I'll just touch on liquidity. And we still believe that high-grade fixed-rate bonds do provide best liquidity among defensive assets in order to take advantage of the periodic dislocations that do exist in equities. So if you are managing a balanced portfolio, you probably do want to accumulate risk assets opportunistically, and we do feel that high-grade bonds provide the best optionality to do so. And I think Q1 of 2020 was a case in point. So this chart shows how many additional units of the S&P 500 various defensive allocations would have bought you relative to the start of the year. And as you can see, long-term US Treasuries bought you the most additional units of the S&P 500 during the March drawdown, whereas some of the so-called alternative credit exposures didn't perform anywhere near as well. And in the case of private debt, even underperformed large cap US equities. And just finally, just turning attention to, I guess, some of the more shorter term dynamics. So global bonds have been sold off heavily amid acceleration of growth and inflation expectations. So it shouldn't really come as a surprise that longer term bond yields have risen and yield curves have steepened. But that means that bonds now have more defensive capacity given the higher yields and steeper curves. So if the reflation narrative were to fail, loses momentum or just disappoints, we think that high-grade bonds would be the main beneficiary. And also just in the very short term, we also do think that asset allocation rebalance flows should see quite a decent rotation into fixed income from equities, just due to the quarter-to-date drift and the need for many institutions to return to their SAA target weights.
Well, thank you very much, Chum, for covering that. I'll pass it over now to Anthony to cover the BetaShares Australian Bond Fund in BNDS. Over to you, mate.
Excellent. Thank you very much for that intro. Yeah, obviously...
just muted there, Anthony.
All right. Can you hear me now?
Still nothing coming through so far.
Right. Okay. Still nothing? Oh.
Sorry about this, everyone. It's a common problem with modern technology at the moment.
Can you hear me now? Hello? Can you hear me now? Can you hear me now? Hello?
Looks
Can
like
you hear me,
we've got a
Chris?
bit of a technical glitch going on here. We were hearing you loud and clear before the webinar, and Murphy's Law, we can't hear you now.
Can you hear me now? Hello? Chris, can you hear me?
Oh, excellent. I think you can, everyone else can hear you. We just can't hear you. So
Okay.
you go forward, mate, and we'll chime in at the end. Sorry about that, everyone.
Okay. Yes, so you heard me saying hello a lot. Well, just moving to, I guess, the slide pack, and I think we've already touched on some of this previously, but obviously Western Asset is a fixed income only specialist and been around. In fact, this is our 50th year, which is very exciting for us. And you can see here we've been obviously very successful in terms of gathering assets with over 600 billion globally. And in Australia, over 20 billion managed. We've also been very successful in winning awards, which we note there, and very pleased to, in fact, win the Morningstar Award 3 years out of 4, which is certainly very pleasing. Moving over in terms of philosophy, once again, I won't spend too much time on this, but worthwhile highlighting that we're a long-term fundamental value shop. So we do believe that markets do misprice and that we can systematically identify those mispricings and obviously try and emphasize those in our portfolios. But in doing so, we certainly look to have diversified strategies, and you know, it could be thinking about it in terms of the basic don't put all your eggs in the one basket, but what we're trying to do is think about those strategies and ensure that we have them so that they are offsetting at times, in that if we are wrong, then the performance won't be impacted materially, and we like to balance those out with those positions. So not dissimilar to what you'd be doing in your total portfolio, we're also doing just within the fixed income component of this portfolio. Over the next slide, you can see the investment team. I think what you can see very clearly is that it's a very experienced team, and also that we've been together for certainly a long time. Myself, actually over 22 years with the firm, and many other team members got similar terms. And I think that's important for you in terms of when you're looking at our performance, is that it's made up of this team. It's not someone else's performance, it is our performance, and we're very proud of the fact that we have within this particular strategy been able to achieve our targets from a return standpoint, and also within the risk component and risk guidelines of the fund. The next slide just goes through our investment process. Once again, I won't spend too much time on this, but it's important to know that it's a process that we've used across the firm and have used since our inception. So it's a tried and tested process. We're starting up in that top left-hand corner, obviously bringing the ideas from a macro and credit standpoint into our investment outlook. And then obviously we overlay those thoughts from the global team within our thoughts here locally. We obviously use that to build our portfolios, and then use those active components, which you can see there, interest rate duration, yield curve positioning, and also sector and subsector positioning to build out the ultimate portfolio on the right-hand side. And we do that using our risk management team with their support and guidance and oversight in regards to our positioning. The characteristics are listed there, and what you get from this fund is obviously a broad exposure to the market, and that's what we're trying to capture here. And we're trying to provide that defensive part of your portfolio, but at the same time, we believe that within the constraints here, that we can also add a reasonable income to the portfolio as well, and do it in a risk managed way. So you can see there the sector limits. There's a minimum 30% government and semi-government, and that's obviously to ensure that we actually have that defensive component of bonds within this particular strategy. But it does give us the ability to obviously move between the broad sectors within the Australian market, which includes supranational and sovereign bonds, obviously corporate bonds, where we get most of our extra income from. It can cover mortgage and asset-backed securities, as well as inflation-linked and a small component of sub-investment grade, which we typically use just for downgraded securities, so that we're not forced to sell them unless we feel like there's a real default risk. The next slide really just covers sector allocation, and you can see that as at the end of February, the benchmark's on the right-hand side. So this is our broad benchmark in Australia that you'll find a lot of fixed income bond managers use. And what it's worth highlighting that this benchmark has changed a lot, certainly in the last 10 years, as Commonwealth Government obviously been forced to issue bonds to cover really the spending post-GFC, and of course more recently, as we well know, the support packages that went in last year to assist the economy and enable us to continue to be moving forward. And I think broadly said, they've done an incredible job with that, with the help of obviously the RBA, banks also, which is unusual because they were the bad villains in the GFC, but they were actually very supportive through the pandemic, as well as other regulators as well, which all assisted, I guess, to build that Team Australia response. But as a result, as you can see, the exposure to Commonwealth Government in the benchmark has increased materially. If we look back pre-GFC, this would have been somewhere in the vicinity of 20 to 25%. So it's meaningfully different now. Semi-government's marginally higher. Supers and sovereigns used to be a little higher. They've been crowded out by that issuance from governments. And corporate, which used to have an exposure in excess of 30%, has now been whittled down to 7%. Reason why I highlight this is that if you were just buying a standard benchmark hugging bond fund, then you obviously end up getting the moves that we've seen here. So you end up very highly exposed to, high rated, clearly bonds, but obviously a lot of government debt. And there's no need to do that if just because that's where the benchmark's gone, which is why obviously look to BNDS to be an active fund within that. At the same time, ensuring that we're obviously providing the defense that you require from your bond fund, but we believe that we can do that, but also give you a nice return above that benchmark, and we have been able to achieve that. So as you see on the left-hand side, we do have that exposure to Commonwealth Government, but you'll find that generally in the long-dated part of the yield curve. So out in that 10, 20, 30-year part, and that obviously provides that real ballast during times of stress. And as Chamath went through before, this is what really drove the returns through the pandemic period, when obviously things were obviously stressful, and that ensures that obviously you get that offset to your risky assets, which were clearly feeling the pain. As you can see there, semi-governments actively manage that, also moving between the different issuers there, depending on the performance of those particular states. Supers, similarly, we've seen those widen, tighten throughout the last 12 months. And once again, we find it quite efficient to move in and out of those high-grade securities. And then corporates, we've taken the opportunity, through last year as markets got stretched and stressed, and we saw spreads widen. We obviously took that opportunity to buy into names that we feel offered value. We obviously have a very large credit analytical team, and what's worth highlighting in the Australian market is that we do actually have a lot of global issuers in it. So therefore you end up with the need to be able to cover those global issuers, and we can do so at Western Asset because we do have analysts on the ground across the globe that know those companies really well. They know the underlying management, and that can obviously assist us in terms of taking those positions and adding value. And that certainly was where we added a lot of value through the last 12 months. At the same time, we did increase our exposure to index linked during the last 12 months. We saw that they were seriously undervalued there. We were planning to, in fact, get a greater exposure, but that market's quite thin, and we started moving in. It started moving markets. We have actually started to decrease that because we think that market's closer to fair value now, and probably also we also increased our exposure to asset-backed in broader accounts, but you know, once again, just really highlighting that within the sectors that are available to us within BNDS, we're very active and have been able to add value for investors through this last year. And as I mentioned before, you know, we can do it in a way that clearly is defensive in nature. And when you look at this allocation to credit within the portfolio, obviously a majority of it is very high grade. I mean, even the exposure to triple B, these are solid companies. Often you find in Australia, a lot of the triple Bs are infrastructure that obviously makes, and they target, you know, a triple B rating because that's the most efficient funding balance sheet for them to operate. So they're not like they're low grade issuers or companies in that you know, they've got a lot of risk on board. They really are structured there because they do have regulated cash flows, and so therefore feel very comfortable overweighting that sector. But as you can see, a large part of it is in the AA, AAA part, which clearly is providing that ballast. As you can see there, also highlighting the yield to worst for the portfolio of a bit over 1.5% versus a benchmark of 118. There's a nice little yield pickup there for very little difference in terms of the average rating. As you can see there, you know, just 2 notches different from the benchmark. So the average rating being AA minus is a very high grade portfolio. In fact, many countries would love to have a AA minus rating. And so you really are getting that defensive characteristic that you're looking for within your broader portfolio. And I think we've already touched on, you know, the role of fixed income a little today, but, you know, clearly this portfolio, based on what I've run through, is a highly liquid portfolio. So it does enable us to move in and out during times of stress even, and that's based on that build out of that broad portfolio of having government, semi-government, supras, all, you know, generally AA or AAA, easy to maneuver within markets. And credit, you know, generally speaking, within Australia, we have in Australia focused on investment grade only, is also equally liquid and does provide some nice income, as I mentioned before, which is really important in terms of this type of allocation. This slide's interesting, more just to highlight, I guess, where other bond markets are, and really Australia stands out significantly here because when you look at obviously the yield structure, and we've just shown you in red markets where they've got negative yields, which, you know, really for me, I find this incredibly challenging to come to terms with. You know, this is where obviously central banks have driven these curves through different QE programs. And really, that's very problematic for investors, I think, versus Australia, where, as you can see, you know, we're obviously, yes, at the short end where we've got this yield curve control position, we've got the RBA holding cash rate at super low levels of 10 basis points and the curve at 10 basis points way out to the 3-year. Very different from other markets, but from there, as Chamath ran through, we've got a very steep yield curve. As you can see, that those yields being on offer, we're by far, you know, the highest rating and yielding market in the globe. So, you know, clearly for investors, some locally think, you know, obviously bond yields super low. imagine how you'd feel if you were living in that broad mix there at the top. Certainly here in Australia, it does offer you a yield curve. It is very steep, and there's certainly a lot priced into that. Once again, it was highlighted earlier in regards to where we're sitting based on where cash rates are and what the RBA is thinking in regards to movements in the short term. Here we're obviously just highlighting yields and performance of the fund over different years, and you can see there that where yields are actually sitting versus what the returns have been. This is the reason why you're part of a bond fund. It obviously does provide that offset during periods of stress, and as we know, 2019, 2020, clearly years of stress, and bond funds obviously performed incredibly well with that yield moving lower during those periods, and that providing obviously solid returns versus your broader portfolios. And this fund, this page, sorry, obviously highlighting that the added alpha that we've been able to generate from our long-standing unlisted fund, which is being managed exactly the same way as the BNDS fund, which I think is key to highlight, with those same benefits that I've run through in regards to being broad in its allocation, providing that diversification that you want within a bond portfolio, and an exposure to credit. Generally speaking, is very low per issuer, and we do that deliberately. That helps obviously with liquidity and also with that diversification that you want within a bond structure, rather than being clearly focused too much on single sectors. And as we saw over the last 12 months, certainly different sectors have been impacted differently by COVID. And once again, that's the type of broad allocation that you really want within your portfolio mix. And here, obviously, just highlighting some performance. Now, clearly, this is sort of quite short term in focus. And as we know, we saw incredible sell-off in February. In fact, looking back over time, we haven't seen a 10-year bond in Australia move to that degree since, in fact, 1994. So the good old bond route of 94. We saw a similar movement as Chamath ran through earlier, as the market started to reprice and look at bonds in a very different way based on obviously the support that's gone into the economy, the expectations around growth, and more importantly, the expectations around inflation really did spook markets during February, and we're seeing somewhat of a retracement since then in March. In fact, a retracement of around 30 basis points in that 10 years. So we sort of saw a sell-off, in 78 basis points, huge, and obviously driving those negative returns for the last 3 months, and drove into, really the performance over the last 12 months. But importantly, as you can see here, the fund did outperform the benchmark, and the longer term numbers clearly highlighting the benefits of being in a broad fund. The 3-year numbers, the 10-year, and since inception, all significantly over the benchmark, but also just really highlighting, types of returns that we saw during those periods. So why BNDS? I think clearly, as we run through, it does provide that core fixed income solution that everyone's looking for. It's diversified, it's defensive in nature, but at the same time, through active management, we believe that we can add some extra income into the fund through that allocation to credit, doing it in a way that is obviously risk controlled. And I think that's probably the proof statement of looking at those long-term numbers for what we've done in the unlisted fund. It certainly comes through strongly. If you don't want to look at awards and take that as a guide, but certainly relative to our peers, we have had a very strong outperformance versus the benchmark over all very different market periods. And most importantly, it does provide that liquidity and transparency through an ETF structure, which obviously you can access very easily through the ASX. And I think that's really been the key to the growth that we've seen within this portfolio over the last few years.
Excellent. Thank you very much for covering that, Anthony. So we've come up to the question Q&A part of the webinar, and there's a few questions that have come through. So thank you very much for writing those in, and also letting me know that everyone else could hear them apart from me. So there you go. Look, Anthony, while I've got you there, there is a question here from Daniel, is just asking, in terms of the BNDS portfolio, what is the breakdown in terms of fixed and floating?
Yeah, so you'll find that majority is fixed, and the reason for that, and that gets adjusted at times, but the reason for that is clearly that we've got a very steep yield curve now. So if you're buying floating rate bonds, you're benchmarked off BBSW, and BBSW is sitting around that 10 basis points. So if you think about that, and then think about the spread that you're going to get from that bond, or the return from that bond, it's going to be very much limited because of that base rate. Whereas when you've got a very steep yield curve, which we do have now, you're clearly benefiting from a very different yield term structure, and therefore you want to take advantage of that. And hence, we did see some interest and did buy some floating rate bonds there through last year, with the thought that a 3-year floater, depending on the issuer, could provide some extra return versus a 3-year fixed bond. But clearly now, with the yield curve change that we've seen most recently, that attractiveness is gone, and there's certainly much better yield to be had with less risk through fixed rate bonds.
Excellent, thank you for that. And just going over to Chum now, in terms of the polling question around, do you think the RBA will meet inflation targets over the next 10 years? It'd be good to get your view on that. And Anthony, after that, if it differs in any way of Chum's, it'd be good to sort of get some feedback from yourself as well.
Yeah, I think it's important to just keep in mind that the RBA hasn't, really come close to its inflation target of core CPI, between 2 to 3% for quite a while now. And there's some real, let's say, global secular forces that have contributed to that. Starting with, some demographic deterioration, debt overhang, and disinflationary effects of technology. And I feel those forces will, reassert themselves, after we reopen. Although we could see, a little bit of bounce in headline CPI on the back of base effects and some supply chain constraints. But I think the secular forces are so powerful that it is a high hurdle to overcome in order to get sort of core inflation nudging towards 3%. And the RBA have said in order to get CPI to their target, you really need to see wage growth sustainably above 3%. And to get wage growth above 3%, you probably need full employment. And right now, most estimates of the natural rate of unemployment are around 4% and potentially even lower. So there's still a lot of slack in the labour market. So it might take some time before we start to get wage pressures that will start to feed through to core inflation.
Thanks, Chum. Anthony, any differing views there, or you agree with what Chum's just covered?
Yeah, no, I'd certainly support all that. And I think, if anything, as we know, debt loads are even higher now. And in the US is a great example where it's going to increase significantly. And that, obviously has to be repaid at some point. So, there's reasonable pressures there in terms of growth being impacted over the longer term as a result of those debt loads. So, that tends to work against as well growth levels. And yeah, wages side, I think that's absolutely true. And as we well know, some of the major institutions in Australia have basically got on wage freezes. So, for the RBA to reach their targets, it's going to take that, good 3-year period to really get that pressure up. Notwithstanding, we've seen unemployment move significantly lower. it is highlighted by Chum. It's going to need to move to super lows to obviously get that wage pressure coming through.
Fantastic, thank you for that. So another one here has come through. Within your corporate bond exposure, do you invest in hybrids? Obviously, the new issues are priced off BBSW and provide lower returns. Any view on hybrids? Now, I'll get you to cover that, and also, Chum, given that we do have our own actively managed hybrids fund in HBRD, if you've got any views on that after Anthony as well.
Yeah, so it's probably worth highlighting. No, we don't have an allocation to hybrids. We think they have their place, but within a bond fund of this nature that is obviously being built to be defensive in its nature, then clearly, there's no home for that within this portfolio.
Yeah, and our view is hybrids. They definitely have a place in portfolios, but they are still, at the end of the day, floating rate credit, which means that they do tend to, be positively correlated with risk assets more broadly. Although hybrid spreads have compressed quite significantly, but we still do believe that they are still fairly high in credit quality, especially compared to a lot of other alternatives such as high yield credit. And we have seen a bit of a credit rating improvement across the bank hybrid space over the past 18 months or so. And most of the big four listed bank hybrids are now investment grade.
Thanks, mate. And also, we've just got another one here. Now clients are looking at high yielding fund options, looking at sort of those mortgage-backed type of exposures that we're seeing in the market. What type of risk should they be aware of, and how do these type of funds or exposures compare to your traditional fixed income funds with credit exposure? You want to cover that one, Chum?
Yeah, I guess it's important to just assess why the role you see for fixed income in your portfolios. And if you are running a multi-asset portfolio with a lot of equity risk, it's important for your fixed income to have liquidity and to have defensiveness to act as that ballast. And I think with a lot of these other high yielding alternatives, it's important to understand that there could be a lot of embedded risk that might not be apparent in, say, the day-to-day mark-to-market volatility that can only reveal itself during periods of more acute market stress.
Excellent, thanks, mate. And another one here is, what are some of the risks with active management, and why is BNDS a better exposure than other options? Could you cover that, Anthony?
Oh yeah, sure. Sorry. Yeah, all good. Yeah, look, clearly, look, a lot of these other active options, as Chum went through, generally, they are focused around getting that credit exposure. I think the key about BNDS is that it does have obviously that broadness, it has that defensive quality, and most importantly, yes, we do have tools that can obviously alleviate some of that duration risk by moving short or long relative to the benchmark. You can't, clearly, and as we've seen in February with that sell-off, mitigate all of that sort of negative returns that come through as a result of that sharp move high, but there is an ability within the fund through active management to obviously position it to best manage your way through with that broad exposure that it has.
Excellent, thank you for that. And got time for one more question here, and happy for both of you to sort of share your views on this. I know Chum and yourself sort of briefly touched on it in the webinar, but with inflation expectations increasing and I guess those long-term bond yields hitting up pretty sharply, should duration still play a part in a portfolio? Chum, do you want to lead away? And then Anthony, if you've got any different views, or it'd be good to hear your views as well.
Yeah, so I think it just comes back to asset allocation and ensuring that your portfolio, has both inflation and deflation protection. And if you are running a multi-asset portfolio, it's important to see where you can actually get a more efficient, use your capital more efficiently to get that inflation protection. And it might not be in fixed income at all. And I guess my personal view is you'd get much better inflation protection and inflation exposure within risk assets, such as tilting equities towards cyclicals or commodities or buying commodities directly. Whereas fixed income and high grade bonds in particular probably provide unmatched and unparalleled protection against a deterioration in economic conditions and disinflationary headwinds.
Thank you. Anthony, your views?
Oh, look, I support all that. I think that's reasonable. I think what we have seen, and I think Chum once again highlighted it before, is that the central bank's ability to get inflation up has been challenged because of those headwinds that we see within that. And I think although things look a little different this time, clearly central banks are taking a different approach to it by not tightening and making it very clear that they're not going to tighten monetary policy until they actually see actual inflation back in their bands is different to what we've seen in the past, but their ability to do that with those headwinds, I think, is still going to be well questioned.
Fantastic. And I think that's about the amount of time that we've got for today. So thank you everyone that attended the webinar. We really do appreciate you taking time out of your busy week and schedule. Thank you so much for Anthony for coming in at the last minute there. I'm sure all the people who attended really valued your views and covering the funds. And of course, thank you very much, Chum, for also attending and giving us your time today as well. Just a few things to consider. Obviously, investment risk. There's no guarantees for future outcomes. General advice in terms of we didn't take into account anyone's personal circumstances today. And as always, if you need advice, we do implore that you go see a professional in that area. The disclaimer here to finish off, but again, thank you everyone. And we really appreciate you taking the time today.
Thank you, everyone.
Thanks.